Welcome to Global Online. So am I audible to everyone? Please give me confirmation so we will start our lecture. Am I audible? Please give me once confirmation. Hello? Just give me the confirmation of audio video so we'll Can we start today's lecture? Okay. So greeting to all the students. There is some background music. I'm just okay. Give me a second to solve this problem. Now it's clear. Disturbing sound still. Hello. Am I audible? Now it is audible. Hello. Now it is audible. Sorry for. Okay, I will start with from the beginning. Okay, now our topic is started from the what is the basically the marginal costing and the marginal cost. Okay, so here the basically marginal cost means the one of the additional unit company produce. Okay, that is cost of producing of one additional unit. Thus the marginal cost is the amount of by which the total cost change when there is a change in output by the one unit. Okay, if company make a changes, if company add a one more unit of his production of his product in the his production, so how does it change its total cost? Okay, the cost of the production. Okay, so the marginal cost is nothing but a variable cost. Okay, and the marginal cost per unit remain unchanged irrespective of the level of activity and the output. That means here we calculate the marginal costing. The marginal costing is nothing but your variable cost. Okay, so here is the sale minus variable cost. From the sale, when we deduct a variable cost, we will get a contribution. Okay, and from that contribution, when the company deducts his fixed cost, he will get a net income. Okay, this net income. Now what is it? There is a per unit and the total amount. Here is a total amount. Okay, so when the company want to calculate his variable cost, in that case there you can see the changes in the total amount, not in the per unit cost. Okay, if there is an total amount is 10, total variable cost is 10,000 and the unit the company produce, that is 100. Okay, so in that case company divide it with 100, so how much? That is 100 per unit. This is a per unit amount. Now the 100 per unit amount, is it fixed? What I am doing, the company adding the additional unit. Okay, unit of output. So here suppose company produce 101 unit. So in that case, what how do we calculate a variable cost or either a marginal cost? That is 101 multiplied with 100. We are not changing in the per unit cost. The company not changing is the cost of per unit. They are changing in the amount. That is how much you'll get? That is 1010. Okay, so here is it. Okay, so this amount comes in this, that is it is a total amount, and here you can see there is a no change in the per unit cost. It's just opposite to the fixed cost. Okay, so if the fixed cost is suppose the fixed cost is 20,000. Okay, so in that case company produce 100, so what you have to divide it with 100, that is 200. So the per unit cost of the fixed cost is per unit cost of the fixed cost is 200 when company produce 100 units. If company produce 101 units, in that case what? 20,000 divided with 101. Okay, so how much you will get? So in that case there is a changes. Okay, so give me a second, there is an So how much we will get? 198 point something, that is per unit cost. So here you can see there is a change in per unit cost when we are talking about when company is calculating his fixed cost per unit. But when the company is on the variable cost, in that case per unit cost is remain constant, it's remain unchanged. Okay. Now under the marginal costing. Okay, so basically what is the marginal costing? So the marginal costing is it is a useful, or how it is useful to the management. If you see or if you want to take any decision as a management, like how as a sales, how much the sales is increasing, what is the profit level, and what when we are getting, when the company are getting the profit, and to take up the decision planning, forecasting, and all of these are these if you want, if the company want to take a proper decision, so they need to calculate their marginal costing. In that condition, company use the marginal costing techniques. Okay, so the only the variable cost change to the cost unit. Clear? The fixed cost contributed to the relevant period are the written off in the cost, profit and loss accounting against the contribution for the period. That means this is your contribution. Okay, and after that, once you are deducting from your contribution your fixed cost, you will get a net income. What is your net income? Net income is nothing but your profit, either a company's loss. Okay, so it's depend on what? Its sales volume. It's depend on what? Your variable cost. And from the sales volume, when company deducts its variable cost, you will get a contribution. Okay, clear? Now first thing, that is then there are the under the marginal costing technique, the fixed costs are treated as a period cost. Okay, so here the marginal costing is also known as contributory costing. Okay, is also known as variable costing, is also known as comparative costing. Why it is a contributing costing? Because contributing, that means when company adding one additional unit as a production, if the company want to produce a one additional unit of product. Okay, so in that case this is what company contributing. Okay, and in that case if company you produce a more unit of production units of his product, so in that case the cost or the variable cost is going to be decreased. So this is a contribution, either it is decreasing, so there is a possibility that there is a decreasing. Or then variable costing, that it will affect on the variable costing, not on variable costings in the amount of the variable costing, not in the per unit of the variable costing. And here the due to the marginal costing, there company can do comparative study of the costing. If company produce 100 units, how much cost, how much per unit cost, or how much fixed cost the company is paying. Okay, or company is contributing. And when if they are comparing with, if they additionally using, that is 200 units of production, so there is a comparison, there is a comparative costing between how much the company actually producing and how much they want to be produce. Okay, now there is another thing, that is the absorption costing. So in the absorption costing, what is absorption costing? Absorption costing is also a technique. It's both variable cost and fixed cost are charged to the cost unit. That means in the absorption, in the marginal costing, we are going to give the more focus to the variable cost only. But when we are talking about the absorption costing, we include both variable cost plus fixed cost. So what are the changes, what are the charges to the cost unit? Under the absorption costing technique, the fixed cost is treated as the product cost. Okay, so the fixed cost is what it is treated as a product cost. In short, the cost of finished unit uh, in the inventory will include a direct material, direct labor, and both variable and fixed manufacturing overheads. In absorption costing, what you have seen, you've seen that they give the more emphasis in all variable overheads. Okay, and these are the variable overheads are the direct material, direct labor, or your variable direct expenses. Okay, now the absorption costing is also known as a full costing because we include a both variable costing also and the company's fixed costing also. Okay, so variable cost, do you know that is variable cost is direct direct material the company needed to produce a product, the labor which are involved in the factory, variable expenses that is directly affect to the manufacturing sector. Okay, what is about the fixed cost? Fixed cost like a rent, like a go down rent. Okay, if in the go down, suppose in this go down I'm the company storing his 1000 units. Okay, so in that case also the company has paying the 10,000 rupees or 10 lakh rupees as a go down rate. If company additionally sorry, if company additionally store 1000 more unit. Okay, so in that case, again in that case company is not paying the extra amount for that particular, if they are increasing their product of unit in the storage. Okay, so in that case, this is a full costing. That's why it's include a variable costing and the fixed costing. The full absorption cost, that means absorption cost is, that means absorption of full area. Okay, if this is a go down of the company, if I am using this particular area for storing 1000 units. Okay, so this area is still remain. So if company utilize this area again storing the 1000 units, okay, either he is storing this using these areas, still in that case also company pay 1 lakh rupees as a rent. When he's additionally storing 1000 more unit, in that case also company is also paying 1000. That means is absorbing of full area. That's why this is a full absorption method we are in the absorption costing. Now the stock valuation, the value of the closing stock under the absorption costing technique will be higher as compared to higher Okay, so valuation, the stock valuation, the value of the closing stock under the absorption costing technique will be higher as compared to the value of closing stock under the marginal costing technique because of the fixed cost elements. Okay, so in the in the absorption costing, the valuation of the valuation of the stocks is on the basis of the closing stock, and the value of the closing stock under the absorption costing technique is the higher than as compared to the closing stock under the marginal costing. When we are comparing the absorption costing with the marginal costing, in that condition we are talking about the absorption costing and we are talking about the marginal costing. In that condition, the closing the cost of closing stock or the value of the closing stock is higher in absorption costing as compared to the marginal costing. In the marginal costing there is an as compared to the absorption costing there is a less. Okay, now distinction between the marginal costing and the absorption costing. Give me a second. Now, what is the difference between the marginal costing and absorption costing? In the marginal costing and absorption costing, the marginal costing, only variable cost is charged to product and the inventory valuation. So I have already told you that is marginal costing is give the emphasis on the variable cost only, and in the absorption costing the total cost, that means both fixed cost and the variable cost is charged to the cost of production and the inventory valuation. Now in the marginal costing, fixed cost is not included in the cost of product. Okay, the fixed cost we do not include in the marginal costing when we are calculating the cost of product. Okay, it's transferred to, so where we include the fixed cost is transferred to the cost, profit and loss account. Okay, what about the absorption costing? The fixed cost we already include, okay, in the cost of production. Now you can see in the marginal costing, stock are valued only at a variable cost. Here the marginal costing give only and only emphasize that the things you have to be keep in your mind, that is marginal costing give the only and only importance to the variable cost. They include the variable cost. If there is any kind of fixed cost, they do not include this fixed cost in the cost of product. The fixed cost, so where it will be going, so the fixed cost is going to be transferred to the profit and loss account of the costing. Okay, now in the opening and the closing stock are valued at a total cost which in the marginal costing. Okay, now in the marginal costing, profitability is judged by the contribution made by the various product or the department. Okay, so the profit is judged on the contribution made by the various products and department. But in the absorption costing, the profit is measured by the profit earned by the various product and the department. Okay, it is judged, okay, profit is judged by the contribution, but its profit is measured by the profit earned by the various product of the department. So here we are just calculating the profitability of the contribution, only the contribution, and in the absorption costing we can calculate it how much profit they earn. Actually we can measure how much the profit they earn. Okay, now the cost data help to know the total contribution and the contribution of each product. Each product we are adding the one additional unit of product, so it's calculated each product. The cost data is arrived on the conventional pattern, and hence is only the net profit for each product that is arrived at. Okay, so in the absorption costing, the cost data is arrived on the conventional pattern. Okay, and hence it's only the net profit for each product is to be arrived. Okay, the difference is valuation of the opening and the closing stock does not affect the unit of the cost of production, but in the absorption costing, the valuation of opening stock and the closing stock is affect. It's not affect in the marginal costing, but it's affect due to what? Due to the fixed cost, because the fixed cost is included in the absorption costing. Clear? Now what are the advantages of the marginal costing? There is due to the marginal costing, it simplified the pricing policy. How it will simplify the pricing policy? Because since the marginal, or you can say that is variable cost per unit is remain constant. If your per unit cost of your variable cost is remain constant, so you can easily calculate your variable cost from the period to over the period of time in a very short span of time, and it will be easier for the firms or the management to take a decision on the pricing policy. Okay, so this is the simplest pricing policy. Now it is advantage of the margin costing, it's having the proper recovery of overhead, because on on the basis of the predetermined rate, because already problem under or over recovery of overhead, because we not including the fixed cost in this in when we are calculating the marginal costing, so it will be easier to recover the overhead. Now it's having the advantage of it is a realistic profit. It show the realistic profit. Under the marginal costing technique, the cost of finished goods and the work in progress are carried on variable cost basis. On what? On the variable cost basis, and the fixed expenses are written off to profit and loss account, and this show the true profit of the period, because we in this marginal costing company exclude his fixed cost. When company exclude his fixed cost or separately calculate or transfer his fixed cost fixed expenses to the profit and loss account, so in that case on the basis of the manufacturing the trading account, you can say in when you the company calculating his trading account statement or making his trading account statement, in that statement company actually know how actually true profit at the end of the period, how much the true profit excluding the fixed cost. So it will be easier actually how much it's related your production only, not your any go down rate, because these are the go down rate, and these all are the indirect expenses, indirect overhead. So what actually directly related to the manufacturing area is going to be calculate, and on the basis of how much the company get a profit. Okay, now how much to produce, actually in the due to marginal costing the company know that how much to produce. Okay, so the marginal costing helps to preparing the break even analysis. Okay, now the question is that what is the break even analysis, ma'am? Okay, so the break even analysis is what? It's nothing but the point where the operationally there is a no profit and no loss situation. There is a point where all the sales are equal to the total variable cost. What I say, when your sales, when the companies, whatever the company is selling is equals to the variable cost, that means there is a no difference between the sales value and the variable cost. The point where the sales value is equals to the variable cost, and again and with fixed cost. Okay, thereby the presenting, and it show the net income is zero. That means your net income, if company's sales is equals to variable cost plus fixed cost, so it show what? It show that there is the income of the company is zero. That means the company neither losing anything or not gaining anything. Okay, so this is a break even the break even point, and due to the help of this break even analysis company can know how much to produce, which show the effect of increasing and decreasing production activity on the profitability of the company. Now the marginal costing again having the advantages, that is it help in decision making, because you know that the marginal costing help in the management taking the number of decision, like what kind of decision, how much to buy, where to discontinue a particular product, where to replacement of the machinery, because marginal costing is talking only about, is showing the true picture of our manufacturing area, our factory areas. Okay, so that's why. Okay, now what are the limitations? So the limitation is this, there are so many limitations, so here we have covering as much as possible. Now here are the limitations of marginal costing. We have you have already I think you have already got an idea about what is the limitation of the marginal costing. So here the sales staff may make a mistake of marginal costing for the total cost and sale at the price, which will be result in loss or the profit or loss. Hence sales staff should be coached with while giving the marginal costing. So sales staff get confused, they do not actually get a true picture, they do not understand this. So there is a coached while they giving the calculating the marginal costing. Then the overheads of the fixed nature, like your go down rent, okay, fitting and again the like lights and fitting, okay, insurance of the go down, okay. So these kind of fixed nature of the overheads cannot be all together, they are excluded, particularly in the large contract. While valuing the work in progress, actually we are not including this also, it will adversely affect, we are not actually getting the how much the these are the fixed nature of the overheads are actually affect, okay. So some of the assumptions regarding the behavior of the variable cost are not necessarily true in the realistic situation. For example, the assumption that fixed costs will remain static throughout is not correct. That means fixed cost is remain static is not if they are increasing the production. Suppose there is a rent. This is a best example I have in my mind. That is, if the particular go down is full with the production. So this area is full by the product. Okay. Now these areas remain what uh, remain empty, okay. So in that case company also can fill this area, but if company again produce a additional unit, so in that case company need to purchase or need to take on the rent another go down, okay. So this is what is incorrect. That is the fixed cost is remain static throughout is not correct over here. Then the marginal costing ignore the time factor and the investment, okay. This is true, the marginal cost of the two job may be same, but the time taken for their completion and the cost of machine use may be differ. The true cost of the job which take longer time and uses costlier machine would be higher. This fact is not disclosed by managerial costing, okay. Now this is actually look like when the company calculate his marginal costing. So what is the formula of the marginal costing? This is important, the equation of the marginal costing, that is sales minus variable cost, sales minus variable cost, company gets his contribution, okay. Or either from that contribution company deducts the fixed cost, then company get a profit, okay. So what is marginal costing? That is a contribution. Why it is? Because suppose I will give you the example. This is contribution, okay. Suppose sale is 10,000, I am taking 10,000 crores, okay. The variable cost is how much? Is suppose variable cost is 3,000. So how much contribution? 7,000. Okay, so suppose the fixed cost is 5,000. So the profit is 2,000. Now, when from the sales, when company deducts his variable cost, that means from the 10,000, when companies deduct 3,000, how much you will get? 7,000. Okay. Again, the another thing, that is in the fixed cost. In the fixed cost, when company add his profit, that means in 5,000 company add his 2,000, then again company gets 7,000. Understand? So that's why the margin costing equation is sales minus variable cost is equals to the fixed cost plus profit. Okay. So the what is contribution? Contribution is sales minus variable cost, either the profit plus fixed cost. Profit volume ratio, there is a what is the profit volume ratio? Profit volume ratio is nothing but your contribution divided with your sale. How much you are contributed and how much the sale of the company, okay. So this is another, these are the formulas of marginal costing. Okay, there is a break even point formula, that is fixed cost divided by PV ratio. So the PV ratio we have already calculated, that is contribution divided by sale. So in the fixed cost, what we do, the fixed cost is divided with by the PV ratio. And what is PV ratio? PV ratio is nothing but your contribution divided by sale. Okay, this is break-even point. Then the margin of safety, it's what, from the total sale company deduct his break-even sale, so company get a margin of safety. Okay, then and another, in the margin of safety, when the company want to calculate in rupees, so the profit divided by PV ratio. What? Profit divided by PV ratio. Okay, when the company quality to calculate in the quantity, the margin of safety in quantity, in that case profit divided by contribution per unit. Okay, so these are the formula, you have to just go through with the formula. Okay, now the decision making area on the marginal costing. Okay, so the fixation of the selling price, what are the decision area of the marginal costing, how to fix the selling price. Okay, under the normal circumstances, what decisions company need to take, okay, on taking the additional unit of product or not. Okay, then under the specific market, or you can say the export market, or special kind of customer, in that case what the decision company need to take, this all the areas is the decision is taken by the marginal costing. During the recession, okay, at a marginal cost and below marginal cost, and the decision related to the most profitable product mix. Most profitable product mix, that means product mix, like a Dove product is also having the shampoo and also having the soap. Okay, okay, also having the soap. So this is what, this is a product mix. Okay, so decision related to most profitable, these are the two are most profitable for the company. Okay, so selection of the optimal production mix. Okay, substitution of the one product with the another. Either company also, the Nestle company also offer the coffee and also produce the tea. So this is the substitute of each other. Okay, discontinuing or dropping of the product line, that means this is a product line of the company. Suppose this is I'm talking about the Reliance company. So Reliance company also having the Reliance Trail, Geo Mart. Okay, and again the Reliance petrol pump. If in some of the specific product, if the company is not gaining his profit, in that case either the company deciding to drop, or either the company deciding to discontinue it. Okay, so these all the decisions are taken by all with the help of marginal costing. Accepting or rejecting the special offer, either company accept the special offer or either reject the special offer. Decision related to make or buy. Make or buy decision means where the company either company purchase raw material, okay, or either company make with self of raw material of particular for producing a particular finished goods. Okay, retaining and replacing a machine. Okay, either this is a time to retain the machine or either to replace the machine. Expanding or contraction, that means either company in the situation where the company need to expand the product or either to contract the product line. Okay, so these all the decisions are taken on the with the help of the marginal costing. Okay, so we do not have too much time, so here we are just ending our of our session. So in that tomorrow session we will continue with the cost, volume, profit. Okay, and with an MCQs. Okay, because many things we have to. Okay, so we will meet you in tomorrow.